Live from Music City, Nashville, Tennessee, this is your motivational, sensational, inspirational, educational, keenly awaited, highly anticipated edition of the long-term calendar spread. Ladies and gentlemen, boys and girls, trips from around the world, how you doing this fine evening? Hope you're doing absolutely incredible. Got Ben on the cell phone. Bill's here as always. Love seeing your face, Bill. Gail, how are you? Maurice Sykes in the house. What's up, Maurice? How you doing? Niels is here. Big man. Niels, when we getting together, man, in Nashville? I miss you. We got to hang out soon. Ryan, how's it going? Terrence Young, how are you? Jeremy Ghost in the house. We got another 1R joining us. Jeremy Ghostin. What's up, buddy? Tony Lopez, Ufredo. Glad to have you here, ladies and gentlemen. So let me just kind of preface what tonight's going to be about just for a moment. It's going to probably raise a lot of questions, is my guess. I think it's going to raise a lot of questions, which is good. That's always a good thing. If there's a lot of questions arisen, I don't know. Whatever. What we're going to do tonight is we're going to talk about a long-term calendar spread. And this class was actually brought on, and true story, entirely by one student's demand and request for it. I'm sure he'll be here soon, but his name is Ken Botnet Jr. And I met Ken in Chicago. He's a dentist. He's an amazing guy, great trader. And he was asking about this because it's just kind of an interesting strategy. And it is a longer term strategy, but this class is more or less to let you guys know the how it works. I'm not going to focus as much on the when, because the when can be a little complex. And bottom line, the when, as in like when to get into these type of spreads, is really up to you. And it does require a little bit of finagling every now and then. But the how, we will be covering the how tonight. We'll cover the why and hopefully answer all of your questions. And then from there, if you guys have any questions, of course, feel free to type them in. This is a 100% judgment-free zone. And Angie Barbosa, a.k.a. the Gapette, the number one Gapette, is here answering your questions. So let's talk about it. The long-term calendar spread. What I'm going to do is I'm going to zoom out here on the monthly chart on the SPY and really soak in where we're at, what we're doing, and what everything is going on here. So let me just kind of hide all the drawing tools, and let's talk about this for a little bit. What do you guys think, ladies and gentlemen? Is there a good chance, probability, or possibility that we could go down soon? What do you guys think? Type in a 1 if you think there's a good chance. All right. Got a lot of 1s. Yeah, there's a possibility, right? I'm not saying it's going to happen, but there's a lot of traders, a lot of people, a lot of theorists out there that say the market could roll over. And maybe you're anticipating a market crash, or in times that you are anticipating a market crash. I think there's a pretty good way to protect yourself or hedge yourself and still, protect either your investments or just capture a really, really big move if it happens. So this particular strategy that I'm going to teach you is good for market tops and or market bottoms. Now, a lot of people are going to say, well, Jeremy, how do you know if you're at a market top or a market bottom? Well, absolutely, in this general area, we definitely, without question, are at a market top. We have a big pennant pattern on the monthly chart. And according to Mr. Bollinger, if you guys know who Mr. Bollinger is, John Bollinger, he put on his personal Facebook yesterday. Yes, I am friends with John Bollinger on Facebook. I don't think that's impressive. I'm pretty sure everyone is. Anyway, he posted on his Facebook that the Bollinger Band width is the lowest that it's been since 1983 on the S&P 500, which means that we're squeezing, that something's going to happen, that there is a volatile move approaching. And there are, again, a lot of analysts, a lot of theorists out there that say the market could do this. I'm one of the ones that say it could do this. I'm not really sure which way it's going to go, but here's what I can say. There are a few strategies out there that you can implement that are not very expensive and can help you manage risk in these situations and also protect a downside move and or reap a little bit of profit on a downside move. And I know a lot of times you were saying, don't try to pick the top, don't try to pick the top, don't try to pick the top. But in situations where you're like, I'm not really trying to pick the top. I just want to mitigate my risk or protect myself when the market is super, super, super high. Here's how you do it. You guys ready? First and foremost, you would do what I like to refer to as a leap put. A leap put. Now, a LEAP stands for Long-Term Equity Anticipation Security. It's an option that has at least 9 months to expiration. So if the market is at a tipping point or at a very high level or a place where you think that there could be a lot of shakeout going on, you could consider buying a LEAP put. Now, I'm not saying this is what you need to do, but again, Ken was was asked me very specifically, like, hey man, I got some investments. I want to protect myself just in case the market does roll over. What could I do? And this is a strategy where you can buy some LEAP puts because you guys know that puts go up if the market goes down. Pretty much all of you guys know that. So my goal in this particular scenario is to more or less teach you guys to say, all right, well, if you do buy a long-term put or a LEAP put, how could you reduce the cost of that put in hopes that the market might go down, or in case it goes down, you at least protected yourself? So what we're going to do is we're going to go to an option chain. And again, the win of this strategy is much longer term. That's really not what this class is about. The class is not going to be very much about the win, but it is going to be the how and the why and the way it works. I literally typed in win. That's how my brain works. Okay, let's go to ticker symbol SPY. SPY. And let's click on options. And someone here, if you're in class, feel free to give me a time frame that you would like to look at in regards to a protective put. What do you guys think would be a good time frame? Any particular expiration? You guys can tell me whichever one you guys choose. What do you think would be a good time frame to choose? A LEAP. So a LEAP is at least 9 months. So Jeremy Kardashian says September. So September is a possibility, but right in this particular trade, we're talking long term. We're saying long term. Like the market could crash. We need to buy a LEAP. We're at an all-time high. How do we protect ourselves? Right? This is not a normal swing trade. This is what's referred to as a calendar spread. It was what I'm teaching, is what we're going to get into. So let's go out and go all the way to January 2017. Wow. January 2017. Yeah, I know it's a long way away, right? A year and a half. So we're buying some time on this trade. So with long-term options like this, if you're buying a long-term option, I do usually buy out of the money. Because you're expecting the stock to move at least a little bit, and it's going to be very, very expensive if you're going to be buying a long-term option. Now keep this in mind. This might shock you that it's not going to be as much as you think. Right now the SPY is at pretty much let's call it 210. If we bought one 205 put, it would cost us $1,647. That's not that expensive, is it? I mean, in the grand scheme of things, $1,647 for one SPY put at an all-time high when the market could roll over. I mean, there's definitely options and choices out there that it could. I don't know if it will, but let's say it does. Possible, okay? We could buy a 205 put. So 205 would be right here. Now I'm going to zoom in just a little bit for just a moment. But let's say we buy a 205 put and that costs us $16.47. Write that number down because that's going to be important. Okay, $16.47. So what we could do in this situation is simply say, all right, well, we buy the option at $16.47. Let's go over here to the SPY and come into a shorter time frame and ask ourselves, what type of trade could we do from here? So once we buy the option, right, once we actually purchase the option, we can then begin to sell other options to offset the cost of the option that we purchased. So we begin to sell the other option to offset the cost of the purchase. So we buy the January 2017, and right away we could come in. And again, this is the part where I'm not going to get into that much the win, but I'm going to explain how this works. If we come into August, so the 28th of August, and we scroll down to the 204 put. The 204 put is bringing in $1.03. Okay, $1.03. What kind of spread would that create? What do you guys think? Any guesses? Well, if we buy a 205 long-term put and we sell a 204 short-term put, that creates a bear put spread. So let me go back into the daily chart really quick on SPY, and I'm going to write this out for you guys just a little bit. Okay? So buy to open the January 205 put and spend $16.47. So the 205 put, I'm going to draw a line where 205 is. 205 is right here. Okay, that's step number one. Step number two is you could sell to open the August, just regular August 204 put for $1.03. $1.03. That would create, here's 204, right about there. That would create a bear put spread. So let's talk about what that would do, okay? Let's talk about the risks of the bear put spread. The risks of the bear put spread, ladies and gentlemen, is that the SPY goes higher. That's the risk. The SPY keeps going up. But you have a lot of time on your option, okay? You have a lot of time on your option. A long time. So the goal of a calendar spread, specifically this particular calendar spread, again, when the market's at an all-time high or an all-time low, is to hold the option as long as possible and begin to sell options against it, decreasing the value of the option that you bought. So again, theoretically, let's say that we brought in $1.03 every time we did this strategy correctly. If we take $16.47 and we divide it by 103, $1.03, this would take about 16 months. So a year, 1 year, and 4 months away, which would be, let's see, August, September, October, November, December. So that would be like December 2016. So more or less is what I'm saying is in this particular trade right here, if we do it this way, we could pay off that put. Again, theoretically, you could pay off the put that you own and you have it in 16 months. We're doing a January 2017 put. So you would be able to pay off the put that you bought during this transaction over enough time. That's what the calendar spread is. It's like a covered call, but kind of in reverse. This is a bear put spread. Now I'm going to do a bull call spread as well, just as an example. But this is the bear put spread. So the risk is that the stock goes higher and you lose your $16.47 initial investment. What are the potential gains? Well, if you buy a 205 and then you sell the 204, if the stock does this and does this, or does this, or does this, or does something of that nature, as long as the SPY closes above 204 in this scenario in the third week of August, you get to keep your 205 put that you bought. You get to keep it. And you've lowered your dollar cost average by $1.03. Everything is fine. Everything is hunky-dory. If, however, the SPY does not close, and in fact it closes at 2:03 on the third Friday of August, here is what will happen in your account. And I want to make sure you guys are fully aware of this. This is the thing that a lot of people don't teach you about calendar spreads. If you're doing a calendar option spread, that's what this is. This is a calendar option spread. You do not want to let the stock close past your strike price, or the option will get exercised the majority of the time. So what that means is you will literally be short the shares of SPY in your account. So if you do, if you bought one contract at 205 and you sold one contract at 204, you would be short the shares at 204 if SPY closed below $204. So when I'm doing calendar spreads, and again, your goal, and you have no problem if it does go down because your profit's $1. All you're doing is you're simply capping the reward. Does that make sense, ladies and gentlemen? So if you buy this 205 put, so we'll say buy to open the 205, and if you sell to open the 204, you have a $1 max profit. So what that means is, think about this, right? So you bought to open and you spent $16.47. Well, let's say SPY goes from 209 and it closes on the day of expiration to 204. Okay, it closes at 204.01. This option will have increased probably to approximately $19, $18, something like that. So that option would have gone up in value, and you would have made the $1.03 from the 204 put that you sold. So again, I mentioned I'm not going to go into massively into the win, but what do you guys think you could do at that time if that happened? What do you guys think? Stock trades down to 204.01 on the day of expiration, closes above the put that you sold. You still have your long put, which is the 205 January 2017. What could you do? You could just sell another one. Yeah, exactly. So you would sell another one farther away. Where? Oh, I don't know. Maybe a support level. Maybe you sell this one. Maybe you sell the 200 put, and maybe, again, you bring in $1.03 for that one. So now your potential profit is all of this area. Okay? And so as long as the stock closes above 200, everything is fine. So usually with calendar spreads, it is a limited risk, limited reward strategy. And the risk, here's what I do like about debit spreads. The risk is totally the amount that you pay. That's the actual value, like the numeric risk is how much you pay for the option. That's your risk. So theoretically, you can only lose 100% of your investment. You can't lose more. Okay? Sound cool? Now, with this particular strategy, as long as you do your best to, again, you can easily mitigate the risk on this. So, for example, let's say you bought one of these options and you said, okay, well, if SPY breaks above this high, I'm going to stop out. So here's my stop. So this is my stop. You buy the 205 put. Okay, buy to open. You sell to open the 204 put. Sell to open. You have that. And you're going to say, all right, well, I'm going to keep trying to sell these every single month. So you're going to have August, September, October, November, December, January. You're going to keep trying to sell them every single month to lower your dollar cost average of the put that you bought. What else could you do, ladies and gentlemen? Well, if you're neutral and you don't really know exactly which way the stock's going to go, you could, this is a buy to open a put, you could buy to open a call, right? Let me go back to SPY. I don't know how my thing changed like that. Give me 1 second. Sorry about the screen change there. Don't really know exactly how that played out. Okay. So you could buy to open a call. So let's say you buy to open a call. Buy to open a call. and then you sell to open a call up here, sell to open a call. So now you literally have, believe it or not, a bear put spread for your put, and you have a bull call spread for your calls. So you have what most people refer to as a type of a butterfly. Not that it matters, but I'm saying if you have both of them, and the stock goes up, okay, well, you're going to make money on your call. If the stock goes down, you're going to make money on your put. And you know at some point that it's going to break eventually, right? We do know that on the SPY. It's going to break eventually. Worst case scenario, it doesn't. It trades entirely sideways that entire time. And you're just selling your puts and selling your calls, selling your puts and selling your calls to offset the cost of the option as it trades sideways. So hopefully you can pay for your option entirely before the expiration date. And usually you can find cases where that can happen. So the key point to remember in the debit spread strategy or the calendar spread strategy. So a calendar spread, let's explain the difference between a calendar and a just regular old debit spread. Does anyone here know the definition of the difference? A calendar spread has different expiration dates. Different expiration. Usually the same. So these usually have the same expiration date, but it can be a calendar debit spread. You could do both. But a calendar spread is just simply two options with different expiration dates. That's all it is. So for example, if you buy a call, let's say you buy the 210 October call on the SPY, and then you sell the 215 September call. This is called a bull call spread. Let's go find out how much risk that would be, because your maximum profit on the trade is $5. You guys agree? Maximum profit on the trade is $5. If you buy an October call and you sell a 215 September call, your maximum reward is $5, because if the stock goes up, this is your ceiling, 215. So we come back over here to SPY. Let's just go to September really quick. And a September option would cost, just waiting on the internet, let's see, a 215 would bring us in 72 cents. All right. And the October call would cost us, if we buy a 210, would cost us $3.76. So this one is $3.76. This one you bring in 72 cents. So your maximum risk is $3 and your maximum reward is $5 in this exact bull call spread. Now the cool news, again, so your risk reward ratio is good. Your cool news in this situation is, let's say, again, best case scenario, the stock goes up a little bit, pauses here, the September call expires worthless, so you keep the call and then the stock continues higher. That's your best case scenario in this position, because now you have a call. You paid for that option, right? You paid $3.76, but you got 72 cents on the premium. So let's talk real numbers, right? This would cost you $376 per option. You would bring in $72 for one option. If you only did one option on both of the trades, your maximum risk is $300. Your maximum reward is $500 on this particular trade. So you have almost a 1-to-2 risk reward ratio, and you have to pay your commissions. So, you got to pay your commissions either way. So maximum loss, let's just say, is plus $8.95, and then, minus $8.95. Or whatever your commission structure is, just as an example. So that's called a bull call spread. So it doesn't really matter. Again, I'm not going through the win, but you can do this in a long stock, like if it's at a bottom. Do you guys know of any stocks that are at a bottom right now? Any guesses? Any guesses? Oh, I don't know. Oil, energy, metal, Twitter. There's a lot of them. So let's go through some of the ones you guys say. Jeremy Kardashian says gold, GLD. I got 3 Jeremys here. Me, Jeremy Ghostin, and Jeremy Kardashian. This is sweet. So let me turn my charts on for gold. I personally don't think gold's at a bottom. I think the next bottom for gold's at 97.56. But that's just me personally, right? Let's say that you do think gold's at a bottom and you buy some, it's definitely at a short-term support from over here. You could buy some longer-term calls and begin to sell calls to offset your losses. And here's the good part, guys. You can do this weekly. You can. If you time it right, if you're really, really good and you're an active trader and you're really reading these signs, if we come over here to GLD, right, and we say, all right, I want to buy a 104 call for a long time out in the future. So let's go to GLD. Long time out in the future. Let's say January 2017. Again, let's just use a long-term option. So January 2017, we're going to buy a little bit out of the money call. So we would buy a, let's say a 106 call option. It costs you $600 per option, guys. $600. It's not that bad. $600 is actually really good. I'm actually kind of considering this now. $600 per option. Okay. Oh, actually, I'm sorry. That's June 2016. Well, still, you got a year. I was about to say that's really cheap. All right, let me go to January 2017. My bad. I was like, man, that is really cheap. Okay, so the 106 on another $200, so $865 per option. Now, again, let's check this out. Let's say that you're getting pretty good at your technical analysis and your charts. And you're like, man, I don't think gold's going to break this 106 level, right? So you go to a shorter term option on gold, and you go to the 106 support, and you sell it for 9 cents. Or maybe you do something even tighter. Maybe you do next week. So, well, I'll say we're already in, tomorrow's Wednesday. Let's do next week. And you do the 106 next week. It's 40 cents. So again, the option costs you $8.50. You start chipping away 40 cents at a time, you're doing okay. So really quick, true or false, if you buy an option, so let's say you buy, I'll go ahead and hide my drawings here for just a moment on gold. And we come over to the 106. I'll get to Twitter in just a second, Dave. I think that's a good point. Okay, so we buy the 106, buy to open the call. Can we sell the 106 call? 106, sell to open, call 106. Can we do the same strike price, different expiration, yes or no? The answer is yes. Yes, you can. You can do the same thing, and you can do it without margin. So margin's not required to do that. But it obviously has to be different expirations. Because if it's the same expiration, then you're selling the same thing you bought. Right? So if you bought to open a call at the 106 January 2017 and sold to open the 106 January, it wouldn't make much sense because it's the same strike price that you have. Right? It's pointless. So you can do this if you have, so if you buy a call 106, you can buy the same expiration as the one that you sell. Obviously, you want to do a little bit of less time frame. But let's say gold does this, forms a double bottom. Jeremy Kardashian's bullish. Stock goes up. Okay. Can you exit, a.k.a. can you buy to close this 106 call? Yes or no? Can you buy to close the 106? The answer is yes. Will that cost you money? The answer is yes. Will you be at a loss on that option? Probably. More than likely, yes. You'll be at a loss because the stock is above the option that you sold. But on the upside, you still have this little guy down here making you money. Now let me go ahead and just flip the script on you just a little bit. This is something that also a lot of people won't fill you in on, but I do this a lot, these kind of trades, so I've just had a lot of experience with this. the shorter term option will move much faster than the longer term option. So when you're doing debit spreads, really depending on how tight you're doing them, don't stress out about it until really the week of expiration if you're in a loss, because that's when you got to figure out how it's going to play out, because theta is going to take its impact. You just got to do your technical analysis on it. But let's say this exact thing happens. This 106 call might be down $300, and this call down here might be up $280. Because the weekly options do move faster and much more fierce than a longer term option. So keep that in mind, even though on this particular trade, right, you're saying to yourself, okay, well, that's only a loss of $20. I agree, it is if you close out the entire thing. But if you buy to close the 106 call, you're going to realize a loss of $300, and you have an unrealized gain of $280 on the call beneath. That is one of the downsides and things that a lot of traders don't tell you, because usually they don't know why or how they don't trade them, but that does happen. If you have a shorter term option that begins to get in the money, it will be down usually a little bit more than your longer term option. Dave says, if the price blows through the front month, can you exercise the back month to cover the front month option? You can, but like again, in this situation, if you did that, Dave, you'd still lose $20. As an example, all right, this is an example. You probably would be down a little bit because the front month option is going to move a little bit faster than the other option. But the answer is yes, you can get both of them out at the same time and just walk away from the trade and everything is great. The benefit of this is if you can do this 3 or 4 times and then things start to move for you. So let's go to Twitter. Okay, Twitter is at a historical bottom. I'm personally a little bit bearish on Twitter, but it could bounce. Right, so here's our lines, and it's at an all-time low. So Twitter is really at an all-time low right now. So let's say on Twitter, now again, I'm going to give you guys some different choices on this, but here's what a lot of traders will do, and this is something that you need to know. A lot of traders will go, well, if I'm buying a January 2017 option, I'm going to buy a call option up here. Is that going to be really cheap? Yes or no? If you buy a call option way up there when Twitter's right here. Yeah, it's going to be really, really cheap. And we'll go look at it really quick. It'll probably be, January 2017. And if we bought a $50 option, it would cost, well, I said really cheap. It's still kind of expensive. $1.94. So $194 if we bought a $50 call option that expires January 2017. What a lot of traders will do is they'll buy this option, they'll buy to open this call, and then they'll sell to open weekly calls right here. I'm not saying that this is a bad strategy. In fact, you can pay for that option very, very quickly if you do that. Very quickly. Because again, this option is only going to cost you $1.94. You could sell a September option right here for probably 50 cents. You could pay this off in like 3 months. But what's the downside risk? Do you guys know? All of that. All of that is the risk. So you can do this trade. It is still a limited risk trade, but this is going to be a lot of margin. And I mean, we're talking technically, this is $18 of margin per contract. So 18 times 100 is $1,800 of margin per contract that you do that with. Which isn't massive, but again, this is a strategy. But keep in mind, folks, options, there are more option strategies than there are anthills in my front yard. There's a lot of option strategies. Everything comes with a risk, and it doesn't matter what strategy you do. If you don't understand the price action, none of it will matter. You've got to understand the price action. You got to understand the chart. Because as Dave says, Twitter is at a very strong bottom. Could it bounce? Absolutely. I did not think Twitter was going to bounce back here, but it did. I was wrong. Once I saw the double bottom, I knew it was going to bounce. Well, I say knew. I became bullish once I saw the double bottom. Okay. So I could be wrong. Twitter could bounce. We could do this and be back up here to $54. But if we're going to do that, we might as well have a longer term option down here and sell it above and not worry about it just in case that does happen. Okay? Just in case the stock does bounce really strongly, at least you can make a little bit of a profit in the end. Does that make sense, ladies and gentlemen? Any questions so far? Dave's asking some good questions. You guys have any other questions for me? So again, for a longer term, for market bottoms and market tops, these can be fun strategies. And again, specifically, if you want to buy a really, really long-term out-of-the-money option, you can. So for example, if you bought a $50 call, it brought in $1.94, you can come over here and you can go, all right, well, I'm going to do a January 2016. Okay, so you buy the 50 and for a long time. So I'm going to show this, what it would actually look like on the chart. Okay, so you could buy to open this. All right. Buy to open this for $1.94. And you could turn right around and sell $52.50. You could turn right around and sell the $52.50 call that's expiring right here and bring in I think it was 52 cents or 27 cents. I forget what it was now. 17 cents. Not even close. 17 cents. So you could do that. It would just decrease the dollar cost average a little bit. But you can see on the chart, unless Twitter does this, this option is going to be less and less valuable. So you'd have to do another one, and then you'd have to do another one, and bring in, if you brought in 17 cents each time. Now, if Twitter got higher, if we did bounce, these numbers would go up. So this would become, I don't know, as an example, 34 cents, and then this could become 58 cents or something, right? The longer you do it. But again, the problem with buying this out-of-the-money option is if Twitter explodes from the bottom and then does this, okay, trades back down January 2017, you're going to lose all of what you bought. Everything. You're going to lose 100% of it. Which, again, if it's a small risk, if you're going in saying, okay, I'm all right with losing everything that I buy up there, that is my risk unit. That is my R. So, for example, if you bought 10 and your risk is $1,000, $2,000, okay, I can understand that and I can appreciate that. If you're buying out the money options, you should go in with that standpoint that, like, okay, this is my risk. This is how much I'm willing to lose on this trade if I'm going to go wrong, which 60% of the time you will be. But if you have one strong trade, this can be a winner. If you buy an at the money or just slightly out of the money call way up here, and then you start selling, calls that are a little bit farther away. So you sell this call, and you sell this call, and you sell this call. As and if Twitter does something like this, okay, in a year and a half, whatever, you're almost paid off the call, and if it bounces like that, you'll make some money. Again, possibilities. If you find a good energy company like Seadrill, these companies, they have dividends and they're energy companies. Energy companies, I think, are going to be pretty fun to do this with because they're getting really, really cheap. Let's go look and see how much you can buy a Seadrill option for. Seadrill is $7 stock right now. You obviously could just buy the shares if you wanted to. But if you bought a 2017 call right now and you bought it out of the money, an $8 call is going to cost you $265. So if you bought 1,000 shares, that would cost you $7,900. And if you're like, okay, I'm in it to win it. That's how much, I'm a risk. My risk is going to be $1,000. That's how much money I'm willing to lose on this trade. You can buy 1,000, you guys can do the math. If you wanted to risk the same $1,000, you could buy 5 of those options, the $8 options on Seadrill, January 2017, and then start selling calls against it. Does that make sense? Any questions about that, boys and girls? Any questions so far? Because again, that's really just the how. That's the how it works, if you will. Any questions on anything else? So we've talked about the risk. So the risk of debit spread. And of course, you can do these shorter term if you want. You can do them as short as you want. Here's silver. And the most recent one of these, like a debit spread that I did on silver, I still am in bearish on silver, is I bought puts back here. And as the trade was coming down, I sold $14 weekly puts. I've done that twice so far. Each brought in 10 cents. So the actual option I purchased, I think, cost, I don't know, $1. So I bought $1 and I've already paid off. I have a September option expiration. So right now my dollar cost average is like 80 cents. Plus the stock is moving in my favor. So right now I think the option's worth $1.20 or something. And I've made about 40 cents on the trade. That's really about it. Questions, concerns, thoughts, or opposing views? You guys sure you're good? I didn't get a lot of questions, but that's really the counter spread. Longer term, it's interesting, especially if you're really tied into the theories out there that the market could crash. If you get really, really good at your timing and your candlesticks, again, if you bought a long-term 205 put, I do suggest when you're doing these trades long-term, you can do a credit spread if you wish, means you sell one higher, right? You just need a margin account to do that. You can do that, right? Absolutely. You totally can do that. But I usually suggest selling the same put, or if you're in a bear put spread, selling the same put or the one below it. You definitely can sell above, but then you're going to be creating a credit spread. David said, thoughts. I'm thinking this would work well with seasonal plays. Yeah, it would. I mean, if you have a seasonal stock and you're, again, it's just a little bit cheaper than buying the actual shares. You can, kind of figure out a way to control your risk in the regards of, okay, if I'm going into this trade, these are obviously a little bit longer term of trades. So seasonal plays like Walmart's coming up. So here's Walmart. Here's my analysis on Walmart. We can see that Walmart has some really, really good support. Support here, support here, support here, support here, support there. Really good support level. So seasonally, you would imagine that Walmart could form this double bottom and trade a little bit higher. So the question just becomes, all right, well, how long do I want to buy Walmart for? Well, I don't know, a year, a few months, 9 months. So come into the option plays or the option chain and look at what options we have available. And we come out here to March 2016. So the seasonality of Walmart would probably be over by March. And you could buy a 75 call for $2.46. So $246, you could buy that option. And then let's say you come into September. So that was a 75. And in September, you can sell the 77.50 for 25 cents. So again, that's a $2.50 possible gain from 75 to 77.50. And then you do the risk. So it's about a 1-to-1, give or take, if you sell that particular option. But a 1-to-1 risk-reward ratio, which is okay. Right? It's not that amazing. Earnings is coming up on Walmart, right? Late August. 77.50 is way up here. Probably won't get exercise up there. And again, if Walmart does something like this, September expires, you have March. You can turn around and do 77.50 again. Stock trades up right there. Boom. And you sell both positions for your profit. So you sell the call down here and you buy to close the call that you sold, exit the trade entirely, and make a little bit of a profit. Now, again, a lot of traders are going to say, well, does this contradict just buying the call and holding it? Not necessarily, right? It all just comes down to the price action, the location on the chart. If you want to be in bullish on Walmart, with a call option for until March and just hold it, you definitely can. But me and you both know that Walmart's not going to do this. If anything, Walmart would probably do something like this. Right? So we both know that it won't just rocket ship, more than likely. So if you can trade it at a good resistance, right, of course you could either sell the option if you wanted to, but if it's a long enough option, you have your time on it, you might as well sell a debit spread. I didn't mean to get into this on this particular class, but if you're really playing these strategies nicely, what else could you do? Let's just, again, hypothetically say that you buy a call, March 75 call is the one you buy. Walmart forms a double bottom, trades up on earnings, everyone's really happy. What could you do right here? I'm not saying this is going to happen, but let's just create a plan that says it does, right? This is October. What can we do? Well, if you bought a long-term call, ladies and gentlemen, I put it to you this way. If you're ever profitable on a trade, you should never lose. Especially if you have enough time. If you're profitable on a trade, you should never lose on that position. It's kind of one of my thoughts. So you could sell a call, buy a put, and get into a collar. Just a regular old options collar, nothing special. Right? This is the debit spread up there. This is the protective put down there. If Walmart does this, okay, your put will protect you, and you sold the call to help purchase the put. Plus, you had your call anyway. Same thing as owning shares on the stock, just in a collar strategy. And then again, keep in mind, with options, one of the things a lot of people don't tell you is if the option is in the money at expiration, something very likely will happen to your account. So if you have a call and the stock closes below your put that you got into with this collar strategy, you will sell short the shares. Now, you have the right to buy those shares lower, so it's okay, but I'm just letting you know that it will happen. So you still have the call option, which is the right to buy, so you do want to sell high and buy low. It's not a scary thing if it happens. Okay? You can just exercise your call, the right to buy shares, buy the stock, and you make a profit. I'm just letting you know, don't be afraid if it happens, because if the stock closes in the money at your option, there's a very good chance something could happen to your trade. Mr. Fredrickson says, i.e., RBOB. Gasoline goes up every year starting in March, peaking in May. A leap might work. If I bought it now and paid it off between now and March, selling cost reduction. I agree. Is RBOB, is that a stock? I'm probably typing in wrong. Or maybe it's a futures. You might be doing, it's a gasoline ETF. RBOB. I've never heard of that one. I believe you though. My chart might maybe have a different ticker for it. But USO, I mean, there's an example. USO is very inexpensive right now. It's at a support price, kind of. It's kind of breaking through it, but it's there. I mean, personally, again, this all it still coincides with price action, guys, right? If you do the wrong strategy at the wrong time, it doesn't really matter what you do. You're going to lose if it's just at the wrong time. So, for example, right there, if you did a bull call spread and you bought a long-term call right there and then sold a call up here, you're going to be losing on the trade. Now, this option will go up in value, but this one will go down in value. USO was at a resistance. Does that make sense? So, again, guys, price action is still really, really important. Can't get around that. It just is. This is just a strategy that can kind of be interesting, especially at, market tops or market bottoms. It can just be unique because we don't know if it's going to roll over, but let's just make it fun for just a moment and say that the SPY did roll over and you had in your possession a January. So let me hide these screens again. So let's say you did have a January 205 put and the market had, a nice 10% correction. 10% correction is 20 points. So that would be 205, 1, 95 is 10, 185. Right? Pull back and bounce. How much would your option be worth? Well, if the SPY is at 185 and you bought a 205 put and we just paid $16.47 for it, you can do the math. That option would be worth approximately 20 points. I mean, at the absolute lowest ever, it'd be worth 20 points. So you make a $4 profit. But we know that with that long of a time, it would be worth more than that. It would be worth more. Dave says, try UGA for RBOB on TradingView. All right. UGA, United Gasoline Fund. There it is. Learning something new today, man. Thank you. I've never heard of this guy before. Now, this one has very, very low volume. So I guess that's a very good point. This strategy really works the best, and when I say best, I do mean the best, with options, with stock that have a lot of volume. So this stock doesn't even have options past January 2016. So just something to keep in mind is look at the volume and find something that has a lot of volume. I mean, talking millions and millions and millions. 10 million or more. Something that has some stoutness to it. Because that's going to have more than likely weekly options. And if you have weekly options, man, guys, if you're really an active trader and you're like, oh, you're looking at the hourly charts and you're selling your weekly options. I mean, I know a trader that I'm a really good friend with. He does this leap strategy often. He'll pay off a leap in 4 or 5 months. And he has the leap for another 5 months for free. He's just kind of sitting there, which is pretty cool. So something to consider. Again, for market tops, you have a mitigated risk. So limited risk, limited return, just in case it does go up, you've mitigated your risk. And again, you can, the entire time, if you have this put, you can begin to sell puts below it like that. But again, that's going to be a credit spread if you sell the put above the put that you bought. But if you have a margin account, you can do that. And if you're selling the puts as it goes up, and then you start to see it roll over, and you're like, okay, I'm going to wait. Then it rolls back over. You've decreased your dollar cost average, and the option that you bought is not going to lose that much because it has so much time value. Making sense, boys and girls? Right on. All right. Any questions? I think it's pretty much about it. Timing, on this particular strategy, I would say timing is probably the most important thing because it's just all about understanding the candlesticks and the price action, regardless of what strategy you're doing. And these are just simple debit spreads. And you got to know that if the spread, and the most important thing for me in this whole lesson, is if the stock closes in the money on the option that you sell, things are going to happen to your account. You'll either buy shares, short shares. It will happen. Now, obviously, you still have the option there as a protection, but unless they're the same expiration date, stuff will happen. If they are the same expiration date, so let's say randomly you buy a 205 January put on the SPY. This will be my last example. Let's say you do a really, really long term and you're like, I think the SPY could drop. I don't think it's going to drop that far. So you buy a January 2017 205 call option. I'm sorry, I apologize, put option. You buy the 205 for $16.47 and you turn right around and you sell the exact same expiration date at $185. This is actually kind of a cool strategy on SPY if you think about it. Your maximum profit on that trade is $20. Your maximum risk, however, is $16.47 minus $9.61, which comes up with 6, 5, 14, 8. No, it's 9, 10, 16. 16 minus 9 is 7. So you're looking at about a 1-to-3 risk-reward ratio. Might be doing the math wrong. Carry the 1, 16. 16 minus 9, yeah, 7, I believe. Should be. So anyway, you guys get the point? It's not a bad, I mean, like if you're like, man, the market's going to tank just a little bit. All right, well, if the market tanks, $7.86 is the premium. That's your maximum risk. Again, you could sell farther out and get a higher possible profit. You're just going to lower your average. And that's a trade that you don't really have to do anything with. I mean, that's the thing. If they're the exact same expiration, you can just kind of set it and forget it, because worst case scenario, stock does this. Best case scenario, stock does this. And you make your $20 on the option. You just hold it till expiration. January, if you really wanted to. You just hold it and hold it and hold it. And of course, if the market really does tank, then you can obviously buy more puts, if the market really is tanking, right? Because we know to do that. Very cool. I love it. Dave says, well done. Thanks, Dave. I appreciate it. Scott says, yeah, I'm still a newbie, but I think I'll have to rewatch it a few times to get it. No worries, man. Like I said, this is definitely this is an option. This is an advanced option play for sure. So feel free to watch it. If you have any questions, let me know. One of the things that I found that helps traders the most, let me see if I can draw this diagram, is just understanding what's in the money and what's out of the money. So if I say in the money, put, call, stock price. I'll see if I can make this make sense. This is one of the things that confuses the majority of people. So if you can really figure out in the money just numerically, you're going to be fine. So in the money for a put is always above the stock price. Call is always below the stock price. So if you're looking at a debit spread, and remember I mentioned if the stock closes in the money at the strike price that you sold, that means that the stock price has to be below the put that you sold in order for something to happen, and vice versa with the call. Stock price has to be above the call. So yeah, it'll take a little bit of rewatching if you're a brand new trader out there, which I'm fine with. We teach brand new, we teach everything, but this is a little bit of an advanced strategy. Not that it matters. But I hope it was beneficial, boys and girls. I figured I would want to wrap you up in exactly an hour. The recording will be posted tomorrow on our YouTube channel. If you're watching the YouTube channel right now as a recording, feel free to subscribe, share it on Twitter, LinkedIn, Facebook, whatever your juice, feel free to drink it. Ladies and gentlemen, thanks so much for being here. I really do appreciate it. You guys and your support of real life trading has really become infectious, and it's slowly starting to sweep the internet. And I appreciate that, because really our goal at Real Life Trading is just to simply enrich lives, to enrich lives. That is our goal, our mission, because we feel that with education, all things are possible. If you educate the masses, that's what grows wealth, that's what grows knowledge, that's what can change economic barriers, that's what can change the future, is education. So I appreciate you being here. Thank you for that. You guys are amazing. I love you. Have a great day. I'll see you next class. And until then, remember, love life, live life, and trade it. See ya.